If you're an investor, the changes to negative gearing and the capital gains tax discount are going to have significant repercussions for you. Firstly, from a negative gearing perspective, if you own a property right now, nothing will essentially change. Those changes are being grandfathered. But if you want to become an investor in the future, you only get negative gearing if you buy a brand new property. And in terms of the losses that you may make on an investment, you can't offset those losses against other income outside of residential housing. So you can carry those losses forward, but it's obviously going to cost you quite a bit of money to do that. In terms of the capital gains tax discount, this is a big one for investors. You're looking at paying a higher rate of tax when you sell your property. At the moment, the maximum amount of tax you would pay when you sell an investment property is about 23.5%. That's now shifting to a minimum of 30% tax on your capital gains. So it's fundamentally changing the investment outlook. The only proviso is, though, if you buy a brand new property, you can still choose the old methodology of calculating your capital gains tax. But overall, I think these changes are going to make investment in residential property here in Australia a lot less attractive. They're trying to drive more investors to brand new properties, but of course, brand new housing tends to be much more expensive. It tends to not grow in price as rapidly as existing homes as well. So the market has just got a lot more challenging for investors. And I think a lot of investors from here on out will be focusing much more on the rental return than the capital growth potential. And that means looking for ways to push up rents and get a better yield.